All right, good morning, everyone. We'll go ahead and get started. So good morning. It's my pleasure to welcome you to the 5th annual Grow the Good in Business Case Competition. My name is Kristen Collette-Schmidt, and I have the honor of serving as the Associate Dean for the undergraduate and specialized master's programs in the Mendoza College of Business. So here at Mendoza, our mission is pretty clear. A career in business is about understanding how organizations can be a force for positive change. Through our courses and experiences like this case competition, our students live that belief while honing their sharp business minds, their problem-solving skills, and their leadership abilities. This year, the Notre Dame Forum's theme is cultivating hope. In a world where hope is in short supply, we reflect on how each of us can be seekers of truth, sustainers of hope, and builders of bridges. The Grow the Good in Business Case Competition perfectly embodies the college's mission and the theme of this year's forum. In previous years, we've seen students tackle critical issues like the wealth gap, health equity, and access to childcare. This year, we are focusing on using financial innovations like stablecoin to develop truly inclusive financial systems. To help us frame this challenge, it is my pleasure to introduce Mendoza alumnus David Juma. David is the founder and the CEO of OurFin, a purpose-driven fintech company focused on narrowing the wealth gap and strengthening financial wellness. With his deep expertise in global banking, payments, and financial market infrastructure, David will help us understand the power of stablecoin before we hear from our students. Welcome, David.
Good morning. Come on, y'all. Good morning.
Good morning.
I know it's bright and early, or today is Thursday, right? But I'm glad to be here. I've been here in 22 years, and it's different. And nice, though, and still very cohesive, but I'm really, really glad to be here. It's really, really much of a big privilege to be back here for the final round for the competition. What we are all going to see today reflects what is truly possible, okay? When students, faculty, and partners come together, especially around the shared conviction. The business, when designed with care, like true care, can expand opportunity rather than constrain it. So this competition is not about a hypothetical impact. It's about disciplined optimism, taking purpose seriously enough to translate into systems that actually work. Over the past few weeks, you all have taken on one of the most important questions in finance. How do we truly design a financial system that not only moves money around more efficiently, but truly move people forward? That is the question that really sits at the heart of today's conversation and around financial inclusion. It also sits at the heart, oh, y'all can come in, around the conversation around stablecoins. Very, very often, when we hear in the public domain conversations around stablecoins, it's usually going to drift into two extremes. On one end, it's hype, right? And on the other end is fear. But we're not here to do that. But for communities that experience the financial system in a different way and do sit at the edges, the conversation around stablecoins is neither abstract or speculative. To them, it's about infrastructure. Because at the core, modern payment systems do not change. Something you all learned in finance, for those that are finance majors, the time value of money. But what it does is to change the frictions that exist. And as a result of that, the risk and the price associated with that. For when money moves slowly or unpredictably, I pay more, you pay more, families pay more, just to have access to your own money. Now think about that for a sec. You have your own money, but because it's moving inefficiently, you have less of it. That's not cool. But it really means something. A small business now has a challenge. Do they delay hiring? Do they put on hold growth? When it comes to remittances, do they arrive late? Or when they do arrive, is it less than what you bargained for? As a result of that, the risk increases. And especially, it falls hardest on those with the least margin for error. That's very important to understand. But at the end of the day, when payments infrastructure improves, when money moves better, faster, cheaper, and more reliably, something very, very important happens. The conversation around inclusion changes, and it stops being aspirational. It becomes more economic. For when I send money back home, I know y'all can tell, I'm not from South Bend. I grew up in Ghana before I came here for college. And like many immigrants, you send money back home. It's part of your responsibility to your bigger family. So when I send money back home, so that my uncle can pay my niece's school fees, what matters to my uncle and my niece is not the novelty associated with it. What's most important is that the money arrives. And when it does arrive, it better be on time, right? It needs to be affordable, and it needs to be predictable. So when I say I send $500, it shouldn't be $480. You know what I mean? This conversation, that is not a crypto problem. That is a financial infrastructure problem. A few years back, I was at a payments conference in New Orleans, great city, by the way, for y'all that haven't visited it. And I shared a simple intuition that at the end of the day, the long-term winners in this space will be well-regulated stablecoins, especially those that truly enhance the payments ecosystem without compromising systematic risk or operational stability. At that time, it was just like one of those intuition or instinct, not yet a framework or a model. But what has stayed with me since then, and what I've seen reflected in the competition, is that progress is not always about predicting the future. It truly is about designing responsibly in the present. And as part of that, anchoring bold ideas is very important. Not just ideas, but bold ones in evidence. But it has to be balanced with ambition and with discipline. And building systems that deserve trust before they demand adoption. Trust is really important. At the heart of the day, trust is a conversation. That is what y'all have been practicing over the last few weeks. As you listen today, listen for the arc of thinking. Purpose, inclusion, infrastructure, economics, results in real-world impact. The strongest teams, they don't start with technology. They began with people. They did ask, who is excluded? Why exclusion persists? And what exclusion truly, really costs. Stablecoins, at the end of the day, is not the end point. I just want you all to remember that. But it is a great enabler to reduce friction, restore trust, shorten distances, building bridges, and aligning systems and institutions and organizations that rarely coordinate well. At the end of the day, what matters most is not only what you all have built today, but how you are learning to think. Because you're in school, right? The goal is to learn how to think and build for the future. Because what you build today and what you have designed, knowingly or unknowingly, may one day touch real lives. But very often, it's quiet. Often, at moments when people have the least room for error. At our firm, the work we do is not theoretical. We focus on building inclusive financial infrastructure with a hyper-focus on the underserved and the diaspora communities, especially when it comes to cross-border payments and remittances, especially for those where this is a problem for cost and they are more fragile. Because inclusion does not scale through good intentions alone. You can have the best intentions, it may be great and awesome, but that's not enough. It truly scales through people and systems that can be relied upon. For when stablecoins are thoughtfully integrated, paired with the right governance, compliance, and real world use cases, they can meaningfully reduce friction in remittances, in emergency payouts, in small business liquidity. This is the goal of this competition and this embodiment of this year's forum theme, Cultivating Hope. For hope is not optimism. Hope is the presence of a trustworthy path forward. I want you all to remember that. Feel free to quote it. Hope is not optimism. Hope is the presence of a trustworthy path forward. What you see today are not the perfect answers, but that's okay. But what's most important is a truly serious path, designed with care, tested with rigor, and truly guided by purpose. For when purpose, infrastructure, and economics are aligned, businesses become more efficient. So you all need to remember the trifecta, okay? Purpose, infrastructure, and economics, right? It can truly become constructive. I'm truly excited to learn from all your amazing and bold ideas. Thank you, everyone. And let's begin. Thank you.
All right, thank you, David, for setting the stage for us. All right, so as you can see here, today is the exciting culmination of weeks of intense effort from undergraduate students, graduate students, faculty, staff, and alumni. And while these numbers show the scale of the competition, the presentations, of course, that you are about to hear really show the heart of it. So today we acknowledge the 53 students across 17 teams who have been part of this competition. It's amazing. They represent all 5 Mendoza majors in all 6 colleges across the Notre Dame campus. We are grateful for the 12 experts who served as mentors and coaches for our students and held office hours with them, and for the 17 faculty, staff, and alumni who judged and gave feedback during the first round of the competition. And of course, we're grateful for the 10 generous sponsor organizations who made all of this possible. And in a few minutes, we'll meet the representatives from these organizations who are here serving as our final round judges today. Until then, let's take a quick look at our agenda. And I've provided a QR code here if you'd like to follow along on your phone. So we'll start the competition with our 4 undergraduate teams. We had a tie this year, so instead of advancing 3, we advanced 4. We'll take a short break, come back for 3 graduate teams, hear from our keynote speaker, hand out awards, and then end with lunch. At this time, I'd like to introduce my colleague Quinn Gallagher, who has been instrumental in coordinating the competition with me this year. If the undergraduate teams could please follow Quinn out to the hallway, we'll get you started in preparing for your presentations. And we'll look forward to hearing from you in a few minutes. And while our undergraduate teams get ready, we're going to take a moment to meet our final round judges. So thank you again for being here and for the time and expertise you will share with us. So I'm going to ask you briefly to introduce yourself, your name, your organization, and your role. And we have microphones across the table if you'd like to turn those on, and we'll work our way down.
So again, David Juma, class of Mendoza 2003, founder of Alphen. Thank you.
Hi, I'm Sarah Burke. I'm an audit partner with KPMG out of the New York office and Notre Dame 1999 undergrad.
Hi, my name's Dave Augustine. I'm a partner with KPMG based in Chicago. I'm in the accounting advisory space, and I'm a graduate from Notre Dame in 1990.
Good morning. I'm Scott Thompson. I'm with First Source Bank. I lead our Treasury Services Division. We support commercial customers and their payments and fraud mitigation needs. I'm not a graduate of Notre Dame. I'm a graduate of the University of Iowa, go Hawks, 2001.
Hi, everyone. My name's Evan Otero-Yomer. Oh, there we go. I'm a director of finance at Visa over in San Francisco. I am also not a Notre Dame alum. I am a Michigan alum.
There's still plenty of time, by the way, for all of you to become.
Good morning, everyone. Michael Nixon, Director for Diversity, Equity, Inclusion, and Belonging for Beacon Health System here in Indiana. I guess this is the not Notre Dame alum section. I'm not a Notre Dame alum. Went to law school at UIC Law in Chicago.
Hi, I'm Jessica McManus-Warnell. I'm on the faculty in our management department over in Mendoza, and I am pleased to help support the competition representing our Notre Dame Deloitte Center for Ethical Leadership. I am a St. Mary's alum, so go Bells, and University of Chicago, so maybe this is the Chicago table as well. Thanks.
So my name is Bruce Lohman. I teach in the Fitzgerald Institute of Real Estate here at Notre Dame, and I graduated Notre Dame in 1988.
My name is Chad Harms. I'm also on faculty for the Management Organization Department, and to counter Scott and Evan, I'm an Iowa State, Michigan State grad.
Hi there, my name is Luke Ronsky. I'm the CEO of the Jubilee Initiative for Financial Inclusion, or JIFFI, which is a South Bend-based nonprofit micro-lending and financial literacy institution. And I'm a current Notre Dame senior. So.
My name is Dustin Mix. I'm here as a proxy for the Notre Dame Institute for Global Investing, but I'm local here in South Bend, run an investment firm that looks at getting more local capital invested in our local city. And I am a 3-time Notre Dame grad, so you guys feel free to borrow any of those. It was mostly because I didn't know how to get a job right out of school. So.
All right, thank you again for supporting our students. All right, so it's time for our presentations to begin. So each team is going to share their proposal in an 8-minute presentation, immediately followed by 4 minutes of Q&A from the judges panel. And so it's time to hand it off to our first undergraduate team.
Hello, we are here today to introduce Credit Halo, where money talks finally. My name is Alex Mizuko. I'm a senior studying strategic management and sustainability.
My name is Christian Loisch. I'm a junior studying finance and sociology.
So when working with first-generation investors as tutors, we found a massive problem. Many of our students felt immense distrust in the financial system, and one of our students even said, "I don't know much about credit cards, but I know I will never get one because my mom says they're dangerous." And here lies the gap that Credit Halo is trying to fill, which is to educate the next generation of future leaders in financial literacy.
When you think about all the problems that are plaguing our world today, whether it's political polarization, instability, or violence, what's the underlying cause beneath all of that? It's economic disparity. We've created a doom loop in our society where people are embarrassed with sharing their finances, they don't take advantage of the tools that are out there, that leads to a lack of financial education, poor financial decisions, and low overall financial health. It's no wonder that they don't trust the financial system because it's not working for them. We found that 65% of Gen Z were denied for a financial product in the past year. And that's the problem we're trying to solve. Credit Halo is offering a 2-pronged approach with a consumer application and an enterprise application. On the consumer side, Credit Halo offers a community where like-minded peers and individuals can come together and share what best practices of what's worked well for them in their financial paths. The idea is that they can set goals, share progress, ask questions, and create an open dialogue where they can learn what's worked for people similar to them. In addition to the community aspect, there's the stablecoin-powered emergency displacement rail. The idea is that the people can request access to funds instantly so they can cover a budget shortfall so they can avoid a credit hit. On the enterprise side, we are offering a replacement to manual denial review for banks because right now, banks are looking at denied applications and looking through them manually by going through traditional credit metrics and seeing why they were denied. Instead, Credit Halo is going to replace that and look at alternative metrics which are more fair in evaluating their creditworthiness and don't look at their past transaction history. So it looks at their ability to pay, behavior with money, and willingness to learn through education to determine their creditworthiness. In addition to the denied borrower support, Credit Halo is allowing people to get a path to approval in the future so that they are not left in the dark from the banks after they're denied. And I want to reiterate the point that stablecoins are an essential piece to making this happen. Because with these people that are struggling with their finances, they're often embarrassed or intimidated and might wait until the last minute to request their funds. And with that, stablecoins offer a low friction, low fee, and instant transfer of money so they can cover their budget shortfall instantly, even if they wait until the last minute.
Now taking a look at what our consumer app looks like, you can see the goals a user can set for themselves, that community aspect where a user can communicate with like-minded individuals, and then, as Christian just touched on, that emergency disbursement fund as well. Shifting to the lender side, we have an example of a student profile using those alternative credit metrics, and an example of a path to approval that a borrower would get after being denied. So we know that there are current companies in the industry working to expand alternative credit metrics today. Credit Halo plans on going one step further in differentiating themselves. By instead of expanding credit scoring metrics, we plan on expanding the usage and understanding of these metrics. So with all of this being said, we see these companies as more partners than competition. When taking a look at our timeline, we're going to start on the consumer side with the app. Then we will shift to the nonprofit partnerships. Then we'll work to build out those alternative credit metrics engine and those denied borrower insights we just touched on. And then we will shift to the lender side and look for bank and credit union partnerships.
When further evaluating the feasibility of a platform like Credit Halo, we need to see what it will take to build from the ground up. So we estimate that to achieve a minimum viable product, we would need around $250,000 so that we can test and iterate and use those insights from our testing and iteration, and then launch full-scale deployment of both the consumer side and the enterprise side, which we would need around $750,000 to do. And here you can see a breakdown of the estimated funding requirements.
So when taking on a project as big as changing people's entire view of the financial system, there are bound to be risks associated. For example, consumers may be uncomfortable with sharing their finances with their peers, and banks may be hesitant to take on a new platform. Finally, specifically with stablecoins, they are relatively new, so they pose risks of their own. With all this being said, we will make sure to address all relevant risks with concern.
It's important that Credit Halo is serving both the consumers and the banks. So we're going to look at metrics for success on both the bank side and the enterprise and the consumer side. For the banks, we want to see an increase in loan originations. We want to see higher approval rates. And most importantly, we want to see young consumers going to the banks who are going to be loyal to them for their entire financial lives. On the consumer side, it's harder to measure, but just as important. And that's an increase in consumer confidence in their own finances, as well as increased trust in the financial system. Credit Halo is creating a positive flywheel where banks are going to want consumers to use Credit Halo, and consumers are going to want banks to use Credit Halo. And that positive flywheel creates a symbiotic relationship because both are on the platform and benefiting from each other. We think it's very unfair in today's financial system that the kids we tutor are living in fear of their finances rather than flourishing in it. It's been instilled in us since freshman year, the idea of grow the good in business, and we think Credit Halo gives us the opportunity to do so. In an American economy with so much innovation, such as AI, robotics, crypto, you name it, it doesn't matter to someone who's just trying to get by and pay their next credit card bill. So instead of living in fear of the financial system, we want people to flourish in it, and Credit Halo gives them the opportunity to do so. Thank you, and happy to answer any questions.
Thanks for the presentation. Two questions related. How would you define the ideal consumer for what you're talking about, or at least where you would start? And then two, with that profile, were you able to talk to anybody of that profile? And if so, what did you learn from them?
I can start with the first question. So we, as you can see in our timeline we discussed, we're going to start with nonprofit partnerships similar to the one we've worked with, first generation investors. And so starting off, that is our ideal candidate. So these students that opt into this program and they're interested in finances, but they obviously maybe are the first ones of their family, to take this step forward. So that is our first step. I don't know, Christian, if you want to build on that.
And if you can flip to the appendix slide next. There, or the adoption. Yeah, so there's been a massive trend among young people who are taking steps to improve their finances and being more open about it, because it's long been a taboo topic to talk about money for older generations. So the idea is that these younger generations are already taking steps to improve their finances and being more open about it. And people are often going to social media to get their advice. So that's really not a trustworthy source. So the idea is we're trying to create a social media that they can trust. And so leveraging what they already use and implementing that so since they already use social media, they can now find a social media that they can trust.
Thanks for a good presentation. Could you just reiterate, how exactly does the model that you're proposing work? What is the service that you're providing that's not already available elsewhere?
Yes, so the whole idea is that we're creating, so there's nothing that's out there that creates a community between the lenders and the borrowers and creates the partnership between the two. So like we said, on the consumer side, they have the community to talk amongst each other and create that open dialogue. But the banks are going to want to see a whole pool of consumers that are willing and taking steps to improve their finances. So they're going to be more creditworthy because they're taking these steps to do so. So they want people on the platform. So banks are going to want people to use Credit Halo. And then the consumers are going to want banks to use Credit Halo because they're getting this path to approval right here. So often banks right now don't have the capacity to give insights on a path to approval, so they're kind of just left in the dark, and then that leads to that distrust in the financial system. So right now, with Credit Halo, consumers are going to want banks to use this because they can get more insights on how to improve, basically.
One more question.
Do you think banks are going to be interested because this has some applicability to their Community Reinvestment Act activities?
Yes, so yes, the short answer is yes. Because if you slip to the appendix, keep going, oh wait, okay, here. So a study we found that low-income people who trust their community tend to make better long-term financial decisions, and that's showing up in a platform like Credit Halo, because if they're talking amongst each other, they have an open dialogue, they're trusting each other, and then they also trust the banks because their banks are being more transparent and giving them a path to approval, they're going to trust their community and the entire financial system. So they're longer term going to make better financial decisions, and that obviously is better for banks because they're going to pay back their loans, they're going to stay with them for their entire financial lives, they're going to buy a house in the future, they're going to get the second mortgage, and so they're going to stay with them for their entire financial lives. So it's really trying to get people early on in their life cycle who trust the bank and are going to make better financial decisions. Thank you.
Thank you.
Thank you.
We're Team Mendoza's finest, and we're here to present our modern take on the Bracero program through stablecoin payments for migrant workers. I'm Clara Lawrence.
My name is Isabel Torres.
I'm Luke Klingel. And I'm Alex Fitzpatrick.
So the Bracero program was an initiative by the United States government in 1940s to increase the number of Mexican migrants working in the agricultural sector within the United States, but it was quickly shut down because the employers were taking advantage of the migrants and financial systems with large remittance fees and just withholding cash.
So the main issue that we identified was that migrant workers in the U.S. are at a disproportionately high risk of being a recipient of wage theft, largely coming in the form of predatory fees, which are disguised by employers as training costs, as well as delayed wage payments. And this is exemplified by a study done which showed that non-citizen status alone increased your likelihood of being on the receiving end of wage theft by 116%, which just goes to show that there's a real need for a safe alternative to the current risky cash-based systems that are being implemented across these economies that are propped up on the labor of migrant workers.
In order to address these issues, we need to understand why existing fintech and current systems fail to target our population. A big thing is bank-centric infrastructure, where we see required accounts, ID, and credit history, which excludes the audience that needs it the most. Legacy payment rails, especially across borders, rely on slow intermediates, so transaction times can take up to 5 days. And that's not even to mention the 5 to 10% remittance fees that come along with it.
In order to solve all of these issues, we propose a stablecoin payment system for these migrant workers, where employers simply have to deposit money into a stablecoin account that is transferred to the employees. The key stakeholders and partners will include the employers, the migrant workers, and some payment providers. And the essential resources we will use are USDC, or Circle, to act as a stable form of currency. And we will also use a Solana, or base network system, for fast transactions that have a very, very low fee. The positive values of this solution is that it incentivizes a digital future and additionally will save lots of middleman costs, saving about $200 a month for these migrant workers.
Just as a simple mock flow, we broke this down into 3 different stages. The first being the employer who's hiring these migrant workers and gig workers. They deposit their USD and it's converted into a cash convention into Circle. Then for step 2, they deposit that into a stablecoin account, which is then transferred to the workers once they complete their work via high-speed and low-cost blockchain. Then for the final step 3, the worker has this money in their digital wallet, which they can then hold on to as digital currency or convert immediately into local cash. Looking at the feasibility of this solution, we believe that it will be accepted amongst migrant workers because they're currently losing roughly 10% of their income due to remittance fees and other settlements, including waiting for the cash to come to their accounts. We believe the employers will also enjoy this because workers are more likely to stay with the company or with the business if they are getting their entire wage. As well, some of the challenges we'll address later are going to be technical literacy and trust among the migrants because some of them don't necessarily have financial literacy, accuracy, as well as technological solutions. And then we believe it'll improve existing solutions by connecting the 1940s to current technology today to minimize the amount of financial abuse that these migrants are taking. Looking at a specific timeline, we once again broke it down into 3 sections, with phase 1 being between 1 and 6 months of the pilot program. We're going to be targeting and launching this with a select group of Visa agricultural employees, or the modern braceros, to test the payroll wallet system. Within phase 2, we are going to then integrate this within a larger scale to the Mexican consulates and remittance partners for cross-border acceptability and facilitating effective payment. And then for phase 3, year 2 and beyond, we're just going to scale this to larger, broader sectors of the economy and additional markets.
We've analyzed some of the risks of this solution according to their likelihood and impact and found corresponding mitigations. 2 that are high likelihood and high impact are low worker adaptation and low access to technology for these workers. For low worker adaptation, we plan to offer bilingual resources for the usage of the stablecoin accounts, as well as in-app tutorials to help with understanding how this process works. In terms of access to technology, we plan to partner with local libraries and post offices of these migrant workers so that they will have a location where they can travel to easily access their account for stablecoin, where the technology of these computers is already in place.
In terms of measuring the success of our proposed methods, we need to look at efficiency, adoption, and reliability, measured by income retained, payment speed, and financial access. Looking at this generalized graph of transaction time and fees, we can see that the traditional payment systems can have fees up to $10 and times up to 5 days, whereas the blockchain institutions can lower these values closer to 0, which is where we would hope to see our methods be in the range of. And then hopefully we can scale this through low-cost blockchain infrastructure to employer partnerships, and then lastly expand to sectors and global markets.
Yeah, and tying our implementation framework to our partnership strategy, we have identified 3 nonprofits that we believe are distinctly suited to be implemented into accelerating the adoption of our solution. The first of which being Mercy Corps Ventures, which is an international venture capital company, which is dedicated to solving the bold and pressing timely issues that the world faces today, one of which being financial inclusivity. The second is Farm Worker Justice, which is a nonprofit that directly works with farm workers across the United States regarding issues such as wages, safety, working conditions, health, etc. And finally, we identified AFOP, which is the Association of Farm Worker Opportunity Programs, who work with migrant farm worker families specifically. And we believe that these 3 organizations are distinctly suited to just seamlessly be integrated into our adoption framework. And finally, we believe that our solution isn't just financially inclusive, but it's also directly tied to the goals and vision of our business school, and by extension, the workings of Father Soren. First of all, we believe that it is mutually beneficial to all stakeholders involved. We have a target of a 99% wage retention rate for migrant workers. And alongside this, we believe that we successfully tackled the technology adoption barriers that might pose a challenge from our standpoint by providing a solution of offering financial education programs and instant cash out options that we believe would mitigate these concerns significantly. And with that, that wraps up our presentation. So thank you so much for your time, and we'd be happy to answer any questions you might have.
Yes.
How do you think that migrant or immigrant distrust in current federal policies might impact your adoption?
Yeah, so I can speak to that. I believe that current discourse within the media really portrays a lot of distrust and kind of stimulates it within the economy and amongst different minorities. I feel that once we kind of eliminate or push towards policy being less direct and aggressive towards migrants, they'll be more open to becoming more assimilated and more involved within the United States economy. But as of right now, I feel like there's just a big issue with policy being kind of negative towards migrants, and therefore the trust in the economy that's supporting this policy within the United States is directly connected in a negative way.
Yes.
I just was wondering, it's definitely a very interesting concept. I don't know if I missed something here, but can you just help me understand the economics of how you will have the capital to continue to fund this? Like, where is your profit coming to help drive the continuation of this program?
That's a great question. So our program is mainly motivated by cutting down on costs. And this is going to keep the employees happy and the employers happy. So we did an estimation that this will save about $200 a month for these migrant workers out of their income, which you can understand why this would incentivize the migrant workers to want to be part of this. Now, the employers care a lot about employee retention. They don't want to have to take the time and resources to train new employees, find new employees. And so we believe they will be willing to work with us to finance this solution.
So do they pay like a monthly fee to use this? Is that how that works? Or
Yeah.
what is the idea there?
We believe they would be willing to pay that fee.
Okay, thank you.
Yeah.
Just wondering, in the research you all did, if there's any kind of a similar sort of payroll infrastructure that operates currently this way for migrant workers. One of the reasons I asked is you all mentioned one of the barriers might be a lack of either tech access or just orientation to these kinds of systems. And so for a worker that, let's say, maybe doesn't have the kind of access to either a smartphone or other kind of smart tech they need to really understand what's happening with their money, how would you sort of navigate that, or how has that been navigated in your research?
I can take this one. So based off of personal experience, I understand that a lot of migrant families, specifically the ones that have visas to work within the United States, are paired with social workers. And so allowing the social workers to become familiar with this program and this project would really help them be able to kind of reiterate it to the migrant communities that they work with directly. Also, I feel like the migrants are very highly willing to work with their social workers. So if the social worker is suggesting that this is a good program for them and they'll save money, they're more than willing to do so.
Thanks.
Thank you.
Thank you, guys.
Restoring wholeness. That's our mission at the Soteria Relief Network, where we deliver stablecoin-powered capital, ready before communities need it most. I'm Grace.
I'm Jacob.
Let's dive into the problem that we're trying to solve today. So natural disasters, they affect us all and they're a deeply human problem. And we want to demonstrate this through sharing the story of Hurricane Katrina, where 1.5 million people were evacuated and over 1,800 people passed away. Of those deaths, 60% of them were elderly. This was just one of the ways in which vulnerable populations were disproportionately affected. Another way was the fact that lower income populations were more likely to live in flood-prone areas. As one survivor describes it, you had to fend for yourself. There just wasn't enough shelter, wasn't enough support. And even 20 years later, some people are still waiting to be made whole. And that gets into the financial realities of natural disasters. As climate change has worsened throughout the years, we've seen an increase of intensity and frequency, and that results in higher recovery costs as reflected on the graph on the left. That being said, the disaster response in the United States is also poor. We have poor coordination across actors, which results in duplicative efforts. For federal aid to be delivered, there requires a FEMA declaration, which has a 67 median day delay, despite the fact that the first 72 hours are critical for improving survival rates. Additionally, over half of Americans lack 3 months of savings, which means that they're over-reliant on federal aid that comes too slowly. All of these problems are exacerbated when we look at the future of FEMA, which is facing major reductions, shifting disaster relief onto state budgets that simply cannot handle the strain. And that's when Soteria comes in.
So we introduce to you our solution, the Soteria Relief Network, named after the Greek goddess of deliverance from harm. We offer disaster relief that's instant, coordinated, and complete, empowering local NGOs to restore wholeness in their communities. So it's three-pronged. The first is a fund that has capital ready before disaster strikes, a platform that serves as a unified command center for real-time coordination across stakeholders, and a fundraising arm to assist with donations. When Grace and I were talking about what key elements our solution should have, we wanted it to be crypto invisible. We wanted it to be compliant with current and future regulations. It needed to address disaster preparedness in addition to disaster recovery. And we wanted to align and consider all the incentives of key stakeholders. So how does it actually work? Well, the first phase, capital inflow, traditional sources of donations use familiar tools like Stripe, PayPal, and for those more crypto literate, Coinbase. And all those donations are automatically converted to Circle's USDC stablecoin. Then we steward those using Fireblock's institutional-grade wallets, keeping funds in 3 buckets of reserves: USDC for fast deployment, cash for Soteria's own operations, and treasuries for yield. Now, when a disaster strikes, our disaster alert system is triggered. Then multi-signature approval is required to allow for the release of funds, so from Soteria and from the relevant NGOs. And there's an instant release of funds to the institution's wallets in just minutes. Now, getting that money out, partners' funds are converted to cash via Circle and then distributed to a local bank account, making their way to the NGO field operation, the people actually making a difference. So, how does joining Soteria work? What's the pathway to partnership? Before joining the fund, partners have to submit a disaster-ready, expert-approved recovery plan. This makes sure efforts in a city are exhaustive, not duplicative, and also has powerful externalities for the community as a whole. After joining the fund, they get access to our platform's tools, lower costs, and simplified fundraising. To make this happen, we need about $6 million of financial capital spread across the liquidity relief pool, as well as team, technology, and technical training. But we also need human and strategic capital in the form of institutional partnerships with organizations like Circle and Coinbase, as well as trusted networks with hub NGOs like Red Cross and Catholic Charities that have national presence. So why do we think Soteria would win in a competitive market environment? Our pre-positioned funds move capital 6 times faster in under 36 hours, which enables response within those critical first 72 hours after disaster strikes. We believe we remain relevant regardless of FEMA's future, and our community-based delivery model removes access to barriers which plague crypto currently. We're also built for the 2026 Digital Dollar Rulebook, already compliant with the current Genius Act, while also taking into consideration the needs of the proposed Clarity Act in terms of using permitted payment stablecoins and protecting self-custody of wallets. So, putting ourselves in the shoes of an NGO, what are their questions? What challenges might they have for us? They might think crypto is volatile, but not here. Using USDC, that means $1 in Soteria is $1 out of Soteria. They might think that this is too complicated, but we want Soteria to feel like a bank-like dashboard, something that's really familiar to them. They might ask, will people even donate? We believe yes. Our research has shown that grassroots responses show strong willingness to give, but lack coordination. And then they might ask, why should my NGO join Soteria? It's that immediate impact. Stablecoin allows for instant global funding and lower costs, and our platform provides stronger coordination in times of crisis. So, to make this a reality, we're going to pilot in New Orleans, not just because of the number of natural disasters there or the number of people in need, but also just because of the amount of great disaster relief charities already in the city. During our first phase, we have to acquire capital, make sure we're compliant, and activate that crucial disaster tracker. During our second phase, we're going to specifically target the city, building strategic partnerships, finalizing those initial plans, and completing our wholeness tracking. But when we think about scale, we don't want to just focus on preparation and recovery. We want to move towards prevention because research shows that every dollar spent on prevention leads to $11 in impact.
So how do we measure success at Soteria? Of course, we pride ourselves in delivering capital as soon as disaster strikes, but what's most important to us is restoring wholeness. And we acknowledge that wholeness is going to look different at different points of recovery. So let's extend this example of New Orleans and suppose that there's a flood, which would be a very likely event. On impact, we're prioritizing speed and immediate relief, and what that looks like for us is reaching 80% or higher of high-risk flood zones. 1 week later, we're shifting into coordination and coverage, so we want access to critical roads such that we can provide public services, and we want that around 60%. 1 year later, we're shifting from recovery into resilience, getting displaced households back into permanent, more resilient housing at around 65%. Lastly, we want to end on how Soteria really embodies Mendoza's mission of commerce as service. And when Jacob and I thought through how our solution can best serve the common good, we were inspired by the UN SDGs as well as writings from Pope John Paul II. Here we found that Soteria serves the common good through 3 main ways. Firstly, through ethical financial innovation, we're able to deliver capital quickly and responsibly. Secondly, we uphold the principles of subsidiarity as well as inherent dignity by empowering local NGOs and treating people as active participants in the recovery process. Lastly, we restore wholeness by closing this critical survival gap by preventing financial freefall. Because at its core, Soteria is not just about delivering capital quickly. It's about restoring wholeness. It's about getting communities back to where they were before disaster strike. Thank you.
I can start. When it comes to the concept in general, can you cover the fundraising aspect? Like, is Soteria fundraising for a fund for themselves or the NGOs?
Yeah, so
raising on their behalf?
Yeah, so we're fundraising on kind of both, but predominantly on behalf of the NGOs. We just want to fundraise enough to make our own ends meet. And when we think about why we want to fundraise for them, we want to have a general fund that's spread across all NGOs, but also use things like disaster-specific funds and charity-specific funds, which people are kind of more accustomed to already.
That's it.
Can you expand a little bit more on the disbursement model? You mentioned multi-signature approval. Is that at the recipient level? Is that at the disaster level? Like, how do you, I guess, make that process quick?
Yes. So when a disaster strikes in, say, New Orleans, all the relevant NGO partners to that disaster are going to be kind of called on. So let's say it's Catholic Charities New Orleans. There needs to be a authorization from the Soteria side and from the charity side. That's kind of the way stablecoins have been working, and we also believe that that prevents from fraud and other kind of bad things that can be related to our solution. And so what we're thinking is almost like a push notification, very quick. There's a lot of digital tools for signatures already, so working with a provider like that to release those funds as quickly as possible.
And to clarify, like, the money is not going to individuals who are affected by the disaster. We're only giving that money to the NGOs.
Thank you.
I have a question. Great presentation. I love the concept. The question I had is, what is your rule? How do you ensure that someone will copy it?
Yeah, so we were considering this, and we looked at like the Porter's 5 forces of like the crypto payments industry. And what we think is that really it's a super competitive market. The barriers to entry are very low. So when we're thinking of our moat, it's that first mover advantage. The reason someone hasn't done this yet, it's a question we've been asked before, is because coordinating all of those acts is very difficult. There's lots of substitutes. There's many actors that need to be involved. So I was kind of inspired by, what's it called? 7 Powers by Hamilton Helmer. It's like our process power. It's like our unique process that gives us differentiation.
Great presentation, and you rightly make the case that there are regulatory public sector barriers to getting this aid out. You did a nice job of telling us the business case for why NGOs would want to be involved in your model. What's the case for businesses? Why, they have benefit from just, directly responding to disasters, so why would they need a kind of a middleman?
Yeah, so, right. Do you want to?
Yeah, so for a corporation to want to donate, one, they kind of have the stake in the game. Say, for example, a corporation in New Orleans, there's a disaster, their employees have been affected. On top of that, though, there's other things such as ESG-related goals. This is a climate-related problem. There is strategic collaboration, so the private sector can play a really influential role, and so again, just embodying that, growing the good in business. And then we have also regional stabilization, which I kind of mentioned before, that employees are also affected.
Yeah, I think we tried to get at this in our metrics, but what Soteria might seem to do on the surface is to move money faster, but the way we grade ourselves is how we impact the communities as a whole. We grade ourselves on how all those externalities are realized, and we hope that's kind of our pitch as well to corporations. By getting money there quicker, having it ready before disaster strikes, there's tremendous benefits. Yes?
So if I saw it properly, your launch expense ratio was 33 cents on the dollar. Can you explain any benchmarking you did as to whether you consider 33 cents to be the high end of the range or the low end of the range, and how that may amortize over future growth?
Could you quickly clarify what you mean by launch expense?
I think you're raising $6 million, and you had a slide that said you needed $2 million to set up your infrastructure.
Yes.
So I take that to be an expense ratio. The $2 million divided by 6 is 33 cents.
Okay. Thank you. That's a great question. We were kind of, when Grace and I were thinking about this, we also used like a model from the book Lean Startup, and we really wanted to treat every part of our solution as an experiment. So this was kind of our almost like lean operating costs. How much would we need to prove validation? When we are thinking of like how much we actually need to run this, maybe after the pilot, after that first year, it would be much more, something on the order of like tens of millions of dollars. However, what we're looking for is validation and making sure that this works before it scales. Thank you very much.
Today we deal with the pervasive issue of gender-based violence, domestic violence.
Hello, my name is Manny Uzabife, and I'm a senior science business major with a triple minor in science and patient advocacy, chemistry, and musical theater.
And hi, my name is Bernice Eintwine. I'm a senior studying business analytics, also with a triple minor in sustainability, social entrepreneurship and innovation, and the business honors program. I'm from the beautiful Caribbean country of Trinidad and Tobago. But despite our beauty, we grapple with the pervasive issue of domestic violence. Time and time again, protest after protest, we continue to advocate for the voices of women, yet we are met with the same question. Why didn't they leave their relationship earlier? Why did they not come out? Why? But statistics show a different story. We know that the number one reason why these women, and we know that this issue affects men as well, we know that the number one reason why these victims stay in abusive relationships is because of financial abuse. They stay or return to their abusive partner, according to the U.S. National Domestic Violence Hotline.
Meet Maria. She's a mother of three. Who has been in an abusive relationship for 6 years, but she has no independent account, no credit history, no ID or documents, and no emergency access to funds. She feels that she has to stay for her children. And there are millions of Americans like Maria. Over 99% of domestic violence cases involve some form of financial abuse.
And this is why we're proud to introduce Haven, financially empowering victims of domestic violence. We are a nonprofit organization, a fully supportive ecosystem where we empower victims with financial tools, with wraparound services, and economic opportunities to help our survivors. We do this in 3 ways. Way number 1, we help victims plan their exit. Way number 2, we help victims process their healing. And way number 3, we help them prosper on their own terms. Introducing part number 1, we recognize that it's up to the victim to make the decision of when they are to leave their abusive relationship. But we want to empower them with enough information, which is why we're proud to introduce a financial app that is disguised as a fitness wellness app, so they're able to track their funding privately and discreetly, and do so in peace as well. Part number 2, we recognize that leaving an abusive relationship is only part 1 of their journey. Part 2 comes from healing, from genuinely processing what they went through. And so, we have wraparound services around our survivor, emotional support, safe housing, as well as health and legal support as well. Part number 3, economic support. We know that it's important to build back, but build back better, which is why we're offering both job placement and microloans for survivors.
Before Haven, there wasn't really a way for Maria. She had no access to funds of her own, and leaving meant starting from zero. But after, she has money that belongs to her, that she knows what she wants to do with it, and these funds are transferred within seconds. And this is why stablecoin is so necessary for Haven. It's instant, so that when she's ready to leave, that she has access to those funds immediately. It's also invisible to her abuser, so she's able to take full control of that because she's the one who knows about it. Also, no ID or credit history would be required, so she's able to make this decision on her own. And right now, Haven is structurally positioned in this regulatory environment. We are not the stablecoin issuer, but we are the ones who are, that's done by Circle, and we're the one who'd be able to facilitate these transactions between the employers, shelters, and survivors. And through to the Genius and Clarity Act, there's actually a federal framework where social service like Haven could actually thrive. Haven is purpose-built for this regulatory environment.
So how does Haven support Maria? Let's take us along on a journey. 1, Maria is in work and she sees a flyer. It directs her to text SAFE to 555, and she downloads our well-being app. Immediately, she starts building her fund quietly. Then she makes a decision. I am ready to leave my abusive relationship, and she gets instant access to her funds. She arrives at the shelter where she's able to get that wraparound support, and then, again, having that processing her emotions, and then she's able to prosper, opting for job placement. We know that Haven makes sense, but we also make dollars. We have 5 primary revenue streams, with 2 of our heavy hitters being employment placement fee, 10% in the first 3 months, and then a shared contribution position as an employee benefit. Our year 1 projections is 500 women served with a 60% job placement rate.
And so in order to make Haven happen, we would have a lot of partners. We'd obviously partner with Circle. We'd also partner with different employers, shelters, and nonprofits to make Haven happen, as well as the City of Chicago and domestic violence coalitions. I also want to point out that for mental health care, we'd work with Timely Care, which is a telehealth mental health provider that many students at Notre Dame use. And what would success look like? In the first year, it would look like targeting 500 women, giving them the means to be able to leave their abusive situation. And by year 3, we would hope to expand this to 2 other Midwestern cities, reaching over 5,000 women or men. And how would these survivors even find Haven? Well, in addition to a bathroom at the workplace like Maria found hers, we'd also do this at shelters, grocery stores, and coffee shops, so that if a survivor ever comes into contact with a Haven flyer, they will know that there's a way out of their situation. And as for myself, as a pre-medical student who has some business acumen, I've seen in my own advocating for and in my own life how financial well-being and socioeconomic status have so much to do in determining health outcomes. Specifically, I advocate for people with substance use disorder, and I hope to continue to in my medical career. And over 90% of women who are treated for substance use disorder have a history of intimate partner violence. And so this is why Haven is so important, because we help plan their exit, process their healing, and prosper on their own terms. Financial abuse is a weapon, but Haven is able to dismantle it, leading to the healing of the whole person. Thank you.
Just from a standpoint of the microloans, I know that in the future you'll have some revenue streams, but is there an initial capital outlay that's required to kind of get set up?
Yeah, that's why we mentioned the ESG corporate grants. And I think those are also very important because that would help us fund something else that did make into the main presentation. In addition to employed survivors, we'd also help underemployed or unemployed survivors using that initial grant money.
Great presentation, great concept. I know one of the main sort of problems to solve here is around getting the word out there around the app while also maintaining the confidentiality and secrecy of the app for obvious reasons. And so I guess the question mainly is just like, how have you sort of wrestled with that? Because the tension being, as you probably know, depending on what study you look at, it takes most survivors somewhere between 8 to 10 attempts to finally leave that intimate partner violent situation. And so balancing that tension between getting the word out there and keeping it secret. I noticed you mentioned some of those different places you'd post about it, but I guess what are some ways to maybe help someone who, gets the app and then is discovered having the app? Have you considered what the fallback option would be for that situation?
Yeah, I think that's a really good question. It's something that we wrestle with because, of course, we want to ensure that the app is discreet, making sure that the victim themselves is safe and is not being put at risk, which is why that we emphasize our partner ecosystem, working with shelters as well. So we encourage and continue to advocate using our partners, the different established domestic violence hotlines, the different embedded within communities, as well as a way to have wraparound services. So we know that oftentimes these women come in and out of these women or men come in and out of these shelters as well. And so it's about relationship building. We also recognize being a financial tool that, there's a bit of mistrust here, and that's something we also wanted to tackle, which is why we're leveraging the trust of these existing established organizations that would have built up that relationship with women over time. So it's not just women or men over time. So it's just not just one instance. So yeah, I think that's a really excellent question. Thank you.
Yeah, I do have a question. Your project is very meaningful. I personally can relate to that because I've seen it in person. But from a financial perspective, one of the judges asked you how do you structure the initial investment, given that we don't know how much of the 10% the future fees are.
So basically, we did it based on an estimate that the job placement would be $42,000, which we think to be a median average of the women that we are seeking, the women or men that we are seeking to employ as well. So that's one way that we structured it. But also looking at a history, given my work, and it's also good to see a partner in this work because it's such an important work. In terms of the kind of grants as well, from being a social entrepreneurship minor. So it kind of came from that experience in my class, learning about persons like Eunice as well, who has a history of microlending in Bangladesh. And so it was taking that experience from class, taken from my lived experience as a woman in Trinidad and Tobago, supporting all these survivors, in addition to external research that we did, that we kind of put together the structure in terms of microloans as well as job placement as well.
All right, thank you.
Thank you.
All right, right, so this concludes our undergraduate presentations. We're going to take about a 5-minute break, and we're going to ask our graduate teams to step out and prepare for their presentations. All right, welcome back from our short break. It's time for our 3 graduate teams to present. So without further ado, let's get started.
October 9th, 2018, Hurricane Michael raged the southern seaboard of the United States. 75 people died. $250 billion of infrastructure damage was caused. Thousands of businesses shuttered their doors, and about 60% of them reopened, and 40% did not. We're going to explore exactly why those 40% didn't open their doors again. And because we're at a fintech conference, I'd like to say it's a money issue. The bottom line is this. That disaster lasted 4 hours. The impact of it, 2 decades, if Hurricane Katrina is any indication. But we can stop the hurt. We can help the people behind the businesses. But we have to get through some status quo inefficiencies first. The status quo is slow. You saw earlier that this process can take anywhere from a month to 2 months to work through. And that's a best case scenario. Because if you're a business owner who's been keeping your receipts that prove you have a legitimate business in your basement, and your basement is now under 6 feet of water, you no longer have a way to prove that you are a legitimate business collecting revenue and get your SBA loan on the right track to getting your money in your pocket. Now, you might not work through FEMA, which, as been mentioned earlier, is being degraded. You might work through a fast cash loan. However, because you are perceived to be potentially fraudulent, you're going to face predatory loan rates, 15 to 30% compounded monthly, maybe weekly, maybe daily, right? The less educated you are in this space, the more likely you are to be taken advantage of, because fraud prevention isn't built into the system. It's also inaccessible. Like I said earlier, if your receipts are in the basement, if you do not have a set up location, something's destroyed, something's taken offline, you may become ineligible for a grant. Now, the small businesses in Panama City, Mexico Beach, Mobile, Alabama, they're hurt, and they're hurt bad. But this doesn't have to be the case.
Thanks, Bridge. We are Team One. This is Bridge, Lauren, Gabe, myself, Alex, and we are here to present to you Recovery Chain. Recovery Chain is a money managed fund which helps to rebuild communities post-disaster. Within 72 hours, we promise them a stable coin that they can then reinvest into their business and get it back on the floor. We only offer, on average, about 2% interest rate, which is compared to the 50 and 30% that Bridge just mentioned. It's not very predatory at all. But at the same time, we're structured as an evergreen fund. Essentially, our capital is reinvested forever. We have 2 prongs to this. Recovery Chain, which is our actual business model itself, and then 8X, which is the actual stablecoin that we are issuing to these businesses. Recovery Chain is instant. We get donors, we get investors, we have a fund that is capitalized, and then we're investing that into treasury, into cash, and then into our stablecoin itself. At the same time, this is an instant thing. We can deploy this within 72 hours. It's controlled, it helps to mitigate fraud, and at the same time, like I mentioned, it's evergreen, so it's completely reinvested. 8X is the actual stablecoin that we are giving these businesses. This is spent correctly, so our vendors are pre-approved, and as a result, this helps to mitigate fraud in the sense that they have to actually allocate their actual vendors, where they're getting their products, their sources, everything like that. It's instantly delivered. Within 72 hours, we can have stablecoin in their wallet, and it's completely traceable. It's spent correctly. This is the solution.
Thank you, Alex. So continuing forward, how does this fund structure work? We have 3 individual beginner investors. We have donors, we have investors, and we have corporations who can act as both. Both of those will flow down to our 8X equity fund. The 8X equity fund will be broken up into 3 individual tranches. 20% of that tranche will be a cash buffer. This will allow us to operate as a business. 40% of that will be in US Treasuries to allow us to earn approximately a 3.69% capital return while it is in the reserve. Loans will earn about 2% return to the businesses that invest in us. On the investor side, we expect a 0.75 management fee, which is significantly lower than traditional private equity funds, and a 1.25% net return to investors. The donor capital will absorb the first 15% of losses, which will give us additional security as a fund. 3 things here. This will give us a stable yield. Development will be impactful for these individual communities, and it'll also protect investor capital.
Thanks, Gabe. So how does it work? First, disaster happens. What then? Our companies that are already pre-approved within our system go and file an application for a short-term loan, and they're already flagged in our system. There's no ability there for us to spend extra time making sure these are real businesses. From there, we take our cash reserve and we put them into 8X tokens that are backed by USD that they can additionally use, almost think as like a prepaid debit card for 8X to go and rebuild and start up and running operations immediately after that disaster impact. The business receives the 8X coin and that token. They're allowed to go to pre-approved vendors that we have already vetted to make sure this money is being used in the right way. Inventory, supplies, mitigating any potential fraud misuse. They get to spend this token at their approved vendor, and from there, the vendor redeems the token for USDC and converts back to USD. Simple, easy, seamless. From there, our companies start rebuilding our small businesses, and they reinvest the principal and the interest slowly over time to replenish back into our fund. The feasibility. This is all the rules of stablecoin are being written right now. The regulatory space is open. We're being built to fit within those guidelines. Within fraud, like I said, we've already had a pre-approved vendor list. We know where we're acting, and we make sure that we've already mitigated all potential misuse of potential use of funds. We have short 30 to 90-day loans that limit our exposure, and donors absorb the additional defaults, protecting investors if need be. Profitability, we have the treasury bills, creating that yield going back into the fund, and we have government contracts as an additional recurring revenue stream. And then, of course, widespread adaptation. It's faster, it's easier, and it's cheaper. We can get cash deployed in 72 hours. In our phase 1, we're going to have a Gulf Coast pilot within the first year and a half, and eventually by year 3, looking at global expansion.
When it comes to the actual financials of everything, we want to look at the profitability. We're mimicking Circle in how they operate their business and essentially how we're distributing our actual money between our 3 branches of cash buffer, treasury bond, and our stablecoin itself. Within our 10 million, 50 million, and 100 million scale, we see profitability at about 11 million without government contract. With a government contract from a local business, we see profitability at a $7 million fund. From there, we're seeing profitability with net margins reaching up to 89% or 88% within a $100 million scale.
Why now? 40% of businesses that experience a disaster never reopen. It takes 45 days from applying for a small business loan to process and get that money. In that time, businesses have already decided to close their doors. On top of that, interest rates for those loans are 15 to 30%. That's not helping, that's not disaster relief, that's predatory debt collection. We're affecting the fact that the regulatory space is open, like I said before. The technology is there. The time is now. It's the right time to invest. It's not a charity. It's a way to actually make an impact.
Thanks, Lauren. To end with a personal anecdote, in October of 2022, Hurricane Ian slammed into the Gulf Coast of the United States. 140 people passed away, including my own grandfather. So how would this affect a community like Fort Myers Beach, where 90 people died? We went down there a year ago. Businesses are still not open. The places that we used to go to with our grandpa, still not open. It's rather sad to see. We see Recovery Chain as a way to allow these businesses that are the fabric of our communities to continue to operate. Thank you so much.
So thank you for that. From a standpoint of the types of investors that you're looking for, can you give a description of where you think, what types of organizations would be interested in that type of an investment and yield?
Yeah, I think any company that wants to be a market for good. I think that if they want to, on their webpage, say, we are investing, we're donating, we're doing all of this kind of nonprofit kind of work, then they're going to be the ones willing to donate. And then when it comes from investor side, they can also be philanthropic like organizations and things like that that are willing to put down their capital for lesser returns than compared to like a typical private equity fund, for example. But at the same time, they know they're doing good. I think a lot of corporations nowadays are looking to kind of be this kind of green company. They're looking to do better. They're looking to be better, and I think that that's what Recovery Chain hopes to do.
I think just to add to that also, corporate governance is at an interesting time where we see DEI going down and ESG going up, and so it's a really cool opportunity for investors to try and make that opportunity to join our fund and look at their ESG reporting.
In one of your slides, I believe you described your coin as non-transferable, and that people would receive 8x the coin and spend it at pre-approved locations. Can you explain a little bit of the technical background as to how you would not have the recipient of the coin just go to Home Depot or Walmart? I'm a little confused about the label non-transferable tokens. Can you explain that a little bit?
Yeah, I'm happy to explain that. So our goal is to get people to buy these goods at a place like Home Depot or Walmart. The issue is if you look at the SBA crisis or the PPE crisis in COVID, a lot of people were taking that money and buying Lamborghinis and taking advantage of the system. Unfortunately, that was costing the taxpayers a significant amount of money in the United States. So by making this a non-transferable token, you can't come to me and say, hey, I just got this money for Plocky's restaurant in Fort Myers Beach, and I'm going to give it to you. No, you have to use it on particular goods that will be beneficial to rebuilding your company from scratch that was impacted.
I think just to add to that, when we say you're filling out an application for a loan, you're asking for an amount and you're detailing what exactly you need. We have pre-approved vendors that we know sell those things, and we have blockchain technology that's clearly tracking what you're spending it on and where you're spending it on, so we can make sure we have auditors full oversight at all times throughout the entire process of that rebuilding.
So if you take the kind of purely predatory lenders out of there and look at like the really good microfinance, like part of the reason you're charging these rates is because the underlying underwriting cost is really high, and it's not super easy to underwrite. So I'm thinking, how are you thinking about underwriting and then also underwriting the fact that like everything could change once the disaster happens, and you could be in a completely different risk bucket than you thought you were before the disaster? I'm just curious how you're thinking about doing that, especially at scale. It could be expensive.
I think all of the risk premium comes in with the unknown, the untraceable, how is this risk premium going to be calculated in? I don't know how this money is going to be spent. I don't know what the return is going to be on. I don't know if you're going to rebuild your business. And it isn't, like you said, it isn't necessarily predatory in and of itself. It's not that 100% of the lenders are saying, oh, I'm going to get them while they're desperate, right? But you have a high risk premium there. We believe we lower the risk premium by having this sort of geocache, knowing where this money is being spent, knowing what it's being spent on, and then having the pre-approved vendors is kind of removing some of that unknown, and the unknown is where the risk premium really accelerates. So by increasing the accessibility of information and thus decreasing the unknown, we give lenders and buyers the peace of mind that comes with a lower risk premium.
I have a quick question. Great presentation, by the way. So how are y'all thinking about, so I looked through what you're doing. There's a lot of different pillars or verticals within financial management that you're doing, right? As a lender, as a potential stablecoin issuer, right? And also, a money manager. So each of those buckets, which are critical to your business, comes with like a lot of regulatory compliance and cost. How are you thinking about it? Because I see a whole lot of cost coming through.
You're absolutely right. It is a complex process. The regulatory rules are going to be different at every phase of it. As USDC is a commodity, it escapes a little bit of the SEC's foresight. But also, the U.S. federal and local governments have a huge incentive, not because they're benevolent, but because when these businesses go out of business, they're losing their tax dollars in perpetuity, essentially. Yeah. And so they're willing to take, at least from analogous programs that aren't using stablecoin, they're willing to invest a premium in products that they believe will get their businesses back online faster. Again, not because big government is necessarily benevolent, but because they like to see their businesses generating tax dollars again. And so we believe that's a good way to finance with local and federal money.
Yeah, bringing communities back and then also bringing that economic impact back to the local communities.
And then that also allows us to work in a more favorable regulatory environment where, because of the sort of ESG aligned goals, they're not trying to strike it down in every way possible and working with. That's not to say the regulatory barriers won't exist, but the government has an underlying incentive to help that work through that so that their communities can get a stable and fast way to get back on their feet and start generating tax dollars and employment again.
Yep, and then on top of that, by mimicking Circle, we are ensuring that we are Genius and Clarity Act compliant. And on top of that, we are mimicking the SDG kind of embodiment of UN. So.
One more slide.
Can I just...
Okay.
Good morning. We are Team Nest Fund, and we are reimagining real estate for real families. My name is Jennifer, and this is my team, Diana, Caitlin, and Chris. We are first and second year MBA students. To help you understand a little bit more about our problem and the solution, we'd like to introduce you to the Johnson family. They make a steady income, they pay rent every month, and they are financially responsible. But they cannot buy a house. Not because they are not qualified or not because they can't afford it, because of a system that was never built for them. They are what we call a thin file applicant with limited credit history. Today, millions of families, like the Johnson family, are locked out of home ownership, not just because they are not qualified. They face 4 key barriers. One is high upfront costs, like the down payments, and thin credit history, limited credit history, and a marketplace that is dominated by wealthy buyers with a limited supply of starter homes and a financial system that is built for people with already wealth. So a lot of families, even though they can afford it and are qualified, they are stuck paying rent and can never build equity. And David, like you rightly asked in the beginning, what does exclusion truly cost? In housing, it costs stability. It does not just cost shelter. It costs stability. It costs the future of communities, which is exactly what our model is designed to restore.
So that is why we built Nest Fund. Nest Fund is a community capital partner home ownership platform that replaces mortgages with direct investment from mission-aligned investors. We're working with capital partners to get 100% of the capital to purchase homes and working with community development partners and organizations to identify these qualified families. So how does this actually work? So there are 5 steps in this process. First, it's the initial purchase. We buy a property at auction, which is below market. And then we develop a contract with the family where we establish a future price based on an annual growth rate in the 10-year term, as an example. And at this point, it's important to understand that the property value already has earned equity because we purchased that property below market. The family is making monthly fixed payments, which is allocated back to the investor through capital recovery process. And also we have a repair reserve fund specifically for emergencies, as well as Nest Fund operating costs. Then there's a reappraisal process, which is where we look at the property value again at the future state once the initial investment is paid off. And there's usually equity on this property. And there is a title split, there's a title transfer to the family, and then there's equity split where the investor can get additional earnings from this. So this results in a win-win-win situation where the investor gets all of their capital returned to them in addition to equity and potential appreciation from the property value. The homeowner gets a full title, they get the property, and they also get access to equity. And Nest Fund, we are operating on fees and managing a platform that is building communities and giving access to families. So when you look at this compared to a traditional mortgage versus rent, we're assuming here that the home value is $180,000. You can see that the monthly payment is slightly higher, but we believe this is within the low income range. So this is still an affordable amount. And the term is 10 years versus 30 years. So people become homeowners much faster than traditional mortgages. And it's important to note that over the lifetime of this loan or this investment, the family is paying $210,000 as opposed to 2 or 3 times the property with a traditional mortgage because of interest rate. We also have a special repair reserve fund built in, which helps us deal with emergencies and help families when they need it the most. And we're also increasing accessibility by aligning ourselves more with criteria more similar to rental the requirements, such as like ID income, and also partnering with local organizations to create trust and find these qualified families. So from an operational standpoint, we have identified 4 key contracts that are necessary to mitigate any risk. So there's a lot of regulation around this, but we are going to address everything from the homeowner to the investor terminology and our role as a manager in this process through a lease agreement, a purchase equity agreement, operating agreement, and a payment waterfall agreement. Now I'll hand it off to Chris to give you more about our stablecoin infrastructure and capital flow.
Thank you. All right. So Nest Fund creates a seamless digital experience for its investors and its homeowners. On the investor side, they're able to access and monitor their payment transactions. They're able to monitor their equity performance over time. And this 24/7 access is really what powers the back end of our platform, which is the architecture and capital flow where we introduce stablecoin. We have investors that will fund their custodial wallets through a Coinbase or Stripe account. Through the use of a Nest Fund smart contract, we will allocate that fund to a property-specific special purpose vehicle, which we will then use to acquire a home that is solely tied to this one smart contract. Once the homeowner starts making their monthly payments through their own custodial wallets, we will exchange the USDC for Nestcoin, representing home equity share for the homeowner. And now I'll pass it off to Jen to talk about our capital sourcing options.
Thank you, Chris. So to fund Nest Fund, we are seeking capital investors. And based on our research, these are the current capital sources that we currently have available in the market. So one is CDFIs, which is the Community Development Financial Institutions. These organizations provide mission-aligned capital to businesses that support community development. And we plan on partnering with them to scale our business, also validate, deploy it at a community level. And as we scale our model, we seek investments from large institutional impact investors that already support projects in affordable housing, and also impact-driven private capital, including family offices such as Builders Vision, Blue Haven, and Windsor Holdings, etc. I'll hand it off to Shiu to talk about forecasting.
Thank you, Jen. So we built a model, 10 years, what we are going to achieve in the next 10 years, the cash flow, our equity value, etc. So our forecasting business sustainability is here. Our key drivers of our revenue comes from those 2 aspects. 17% comes from our platform fee per homeowners from every month payment, and also 1% of property management fee from our investors. And also, when it comes to our property portfolio, we're purchasing more new houses over the years. The amount of our new houses purchased is growing at almost 30% CAGR, and our business model is going to be profitable from year 6, as initially we're still in investment, like growing mode, getting more qualified clients on board. And also for our operating expenses, we assume that the initial major cost is from personnel, which is why we're going to keep our team really lean to lower that personnel cost. And also for the technology part, initially we're going to invest in the platform, which is our from platform development. And later on, the fee is going to go down as we rely mainly on the cloud development, the cloud platform subscription. And I'll hand back to Jen.
So why should you invest in us? Because you want to support a scalable, innovative, tech-enabled solution, and you want to get stable financial returns through structured cash flow and tax advantages like new market tax credits. And most importantly, you want to help communities through their home ownership journey. Thank you.
Thank you for the presentation. I had a question on the general ownership model. So if the title gets transferred after the house is paid off, correct? Who assumes property taxes, homeowner fees, maintenance, all that type of stuff during this time?
Yeah, as far as taxes go, that will be part of the homeowner's fees. And then as far as the, I went one too far. As far as the operations and repairs go, we would build the model out where we essentially have a deductible insurance base for them, where they would be responsible for about $750 a year in repair costs. And then anything above that, we are transferring money as part of the Nestcoin infrastructure. Part of that is being deviated to their own repair reserve wallet that is controlled just solely for that property.
Thank you.
I'm wondering about any research you did to support the idea that these borrowers could really pay this change in their monthly ability. I understand over time they're saving money, but that's not how most low-income families make, decisions like that.
Yeah, so I can help answer that. So through our community development partnerships, we've been able to actually speak with local organizations, and there are approximately 2,000 of thin file applicants that go to the bank seeking a loan and that demonstrate that they have payment history, but they don't qualify because of just no credit history or other more technical reasons. And so we're essentially saying the market is there, right? There are a pool of applicants who are actively trying to seek home ownership that can pay this, and they're proving it. It's just the system is not built to approve them. They're systematically being denied.
Like right now, they're renters or?
Yes.
Okay.
Correct.
Okay, thanks.
Yeah.
What is your default percentage assumption?
So we were looking at two different levels. The American average is about 1.5, FHA is at 11, so we would assume ourselves around 7 to 8%.
Could you talk us through the assumption that you'll be able to purchase at homes below market value?
Yes. So I have personally, I own an LLC for the last 5 years, and buying property on auction is what you're asking, right? Is its own process. This is usually private auctions that occur, and we did look at the auction market to see the volume of available properties over time. So I think most recently was between 500 and 600 homes on the market that we identified that could be below market. So it's something we're developing a home search tool that takes into account different aspects of the property to be able to evaluate how they perform, or the value of that property within the neighborhood and things of that nature. So does that answer your question?
Yeah, I guess I would just follow up with the idea that if they're being purchased below value, there's oftentimes upfront maintenance, how do we get this home livable, right, just to be able to start. So.
Yeah.
Sorry, go ahead. Okay. What's the real value of the stablecoin here?
The real value of the stablecoin here is equity ownership verification, right, through a blockchain network. So by posting these smart contracts on the blockchain network, then we have verifiable proof that a homeowner owns X% of the home and an investor owns Y% of the home, and that will hold as long as the blockchain network is there.
Part of your sustainability seemed to rely on appreciation of home values over time. Was there any stress testing done to see what would happen to the model if home values stabilize or even go down?
So we walked through a couple of scenarios, and speaking of housing market decline in specifically, because it's not really a loan structured program, right? We can build in contractual terms where we talk about delaying the sale of the property for 6 months, where we have agreement between the homeowner and the investor. We can bring in that contractual language because it is not a loan, and there is no one really coming down and impacting their credit score at the end of the day.
Great, thank you.
Yeah.
Thank you.
I want you to think about someone who works right here on this campus, maybe in the dining hall with the grounds crew or the facilities team. They show up every single day and earn a real paycheck. On the weekends, maybe they take up a shift with TaskRabbit or DoorDash to make ends meet. At the end of the month, they apply for a car loan, a lease, or maybe even a credit card, and they get denied. They're not denied because they don't have income. They're denied because the financial system, which was built for a 1950s workforce with a single income and a single employer, doesn't recognize their type of income. Our solution is the Ask Initiative. Access Stewardship Keystone. This is a community-owned stablecoin infrastructure built entirely on Notre Dame's existing infrastructure. It turns every paycheck from every source into a verified financial identity. I'm Amber Clark. Today, my colleagues Kelly Griffin, Stephanie Rigg, and I will use our cross-functional expertise in operations, strategy, and leadership to walk you through this groundbreaking initiative. It will position Notre Dame at the forefront of redefining the foundation of financial identity. Did you know that more than 32 million Americans are credit invisible or unscorable? The credit invisible are U.S. consumers who do not have a credit history or file with the 3 major credit bureaus. This results in no credit score and no access to the credit system. Notre Dame is positioned to steward these individuals into credit visibility, serving as the keystone to their financial identity. Enter the Ask Initiative. This initiative is based off of 3 layers, every layer built on a Notre Dame partnership that already exists. Layer 1 is our stablecoin. Stablecoin is a type of cryptocurrency backed 100% by the US dollar. Under the Genius Act signed into law in 2025, issuing credit unions can establish subsidiaries that issue these payment stablecoins. This blockchain within the existing federal framework is what the Ask Initiative will utilize to issue those stablecoins. Layer 2 is the last mile advocate network. Bonded, trained community operators are the human in the machine. With no app or smartphones required, professionals from community partners such as La Casa de Amistad and Near Northwest Neighborhood Incorporated partner with these individuals to support onboarding into the stablecoin's digital wallet. This system supports those populations that others leave behind. Finally, layer 3 is employer onboarding. In partnership with Notre Dame's Department of Human Resources, Notre Dame hourly workers can elect to enroll on day 1. Every paycheck from every source will flow into the Ask Initiative digital wallet. That becomes the user's on-chain financial identity. It's an earnings record that is a valid alternative to traditional credit score. Notre Dame doesn't need to find a pilot population for this program. It already employs one.
Hello, I'm Kelly Griffin. I'm a social worker who happens to be a business student. So we look at this whole project as a social work project more so than anything. And we bring our community in first. That's our most important ally here. And we want their buy-in. So our community, we want them to grow. We want them to reach self-actualization, whether it be a car loan, a mortgage, and right now the middle class is being hit hard. So this is a great project. Human trust is at the interface is where our last mile advocates come in. And they are trusted partners in our community. And they happen to be notaries, and they can help people get accounts started. Hint, hint, wink, wink, nudge, nudge. Anchor institution happens to be this very institution. Way to go, lead the way, Notre Dame. All right, and then Genius Act compliance. We're gonna utilize Notre Dame Federal Credit Union in this case to keep us in compliance with the Genius Act. Notre Dame will keep us with stewardship and governance. So here's what our partnership matrix looks like. You probably noticed a few of the names are very familiar. This is not a cold call. This is a warm handshake and a welcome home to Notre Dame. Because look at that, we've got blockchain research group there. Wasn't that made here? Yes, it was. La Casa de Amistad, excuse me. La Casa de Amistad in our community in partnership with us since 1973 when it was created. So we're just continuing that relationship. And of course, eventually the city of South Bend, and then the United States, maybe the world, we'll see.
All right, so how are we gonna make this work, the metrics? So initially, we're looking at onboarding 300 Notre Dame hourly workers that work here now. And again, that's the option for them to use the blockchain. For many of these people, this will be the first time in their financial lives that they have a financial identity. Within 12 months, they'll start building an actual credit profile, and their chain earnings will replace the W-2s that would be needed for the underwriting and the input data for CDIF loans. So we're gonna start by bringing them in here, and then they will actually be able to walk right back into the Federal Credit Union in a year and take out that car loan or that personal loan they need to fix their car so they can continue doing their gig work or maybe even a down payment on their first house. Year 2, last mile expands into the community, and now we're onboarding 200 more. So now we've got 500 people in this project, and that's 500 credit profiles that were once invisible that are now seen. Year 3, we can take the playbook out to anchor institutions. Any university, any credit union, any community organization could run this playbook that Notre Dame can write. So how are we going to do it? Day 1, we're going to have 2 revenue streams. We're going to start with a SaaS fee, $5 per person to sign up for their actual account or their wallet. Year 1, that looks like $18,000. By year 3, if we onboard 10 other employers that bring 300 on, we're looking at $180,000. And then the reserve is our float income. The reserves are a 1-to-1 in the reserve held by the subsidiary of the Federal Credit Union, and they can be at 93-day T-bills. Today, the T-bills are like 3.7, 3.6% interest rate. They range between 4 and 3. That is float income. It's just going to be part of operations income. And day 1, $3,700, and then it'll expand as we move on. The average SaaS fee for starting up a program like this is $15 to $95 per person per month. So we went with a $49 average fee. $5 fees and SaaS fees by the worker, and then Notre Dame seeds the remaining $44 per person as seed money for the pilot program. So we're looking at $158,000 for the pilot program. So Cardinal John O'Hara said the primary function of commerce is to serve mankind. That is the foundation of growing the good in business. And that is the inspiration for the Ask Initiative. So Notre Dame already employs these people, these workers. Notre Dame already serves this neighborhood. We're not building a product to sell an underserved community. We're building infrastructure that the community will own. The workers that came in this morning at 5 a.m., their income is real. Their paychecks are real. And with the Ask Initiative, their identity, their credit identity becomes real. The pilot is ready. The blockchain group here on campus is ready. The playbook is ready. Notre Dame has the chance to become the proof that anchor institutions can close the gap between employment and financial dignity. This is access. This is stewardship. This is Keystone. Thank you.
I have a question. Great presentation. I'm just wondering, you mentioned, different Notre Dame employees that you had in mind when making this initiative. Just wondering if you had the opportunity to connect with or interview any employees to get some of their lived experience insights into how you crafted the initiative.
We did not do that directly with employees on campus.
Okay.
It's mostly through our experience, through our own jobs. I mean, Kelly's local, Amber's in Indianapolis, I'm in Detroit, so it's mostly what we see in the world.
Okay.
Maybe a related question is, have you discussed this with anybody at Notre Dame at the institutional level?
We have not.
Okay.
Surprise.
Can you walk me through just the credit scoring gap that you're able to fill here that is hard to have otherwise, and then connect that to where the stablecoin provides some like unique value proposition in doing that?
So we're talking maybe low-income workers who work part-time jobs or several jobs, gig workers whose income looks very different. You don't get a W-2 when you're a 1099 worker. and maybe people who have had hardships with their credits in the past and want to move forward. And then the blockchain is a record of income. Over and over and over, every month. After 12 months, that record is there. Income in, income out. So it starts to build that profile for them. Does that answer your question?
So I want to ask, like, how much percentage of your AMU are the below reserve? And what if the use go up and your AMUs go down? How are you going to react to the fact that the reserve is very low?
So first, we're running through the credit union, which is also nonprofit. So being low is fine. We do not know what this is going to cost because it's new. We tried to associate it with SaaS fees, and we went kind of medium. We didn't want to do like a really high, fancy app that people won't use. So we're looking at mid-level SaaS fees as the cost, but we really don't know what it's going to be. But it is made here. So this is the start, and then we can control, as it moves out of Notre Dame, what the cost would be.
All right, so thank you to our graduate team. So now I'm going to ask our judges to go ahead and exit through these back doors. We're going to go ahead and deliberate together for a few minutes on the decisions. While our judges are deliberating, I would like to ask Quinn Gallagher to the podium to introduce our keynote speaker.
Thank you, everyone, for being here. My name is Quinn Gallagher. I'm a program administrator. Great work to those students on the presentations. I didn't get to see as much as I hoped, but what I saw was incredible. So nice work. I'm pleased to introduce our speaker, Sarah Burke, who comes to us from KPMG. She's a partner with the audit practice with over 25 years of experience. She focuses on companies in the consumer markets and pharmaceuticals industries. In addition to client-facing work, Sarah's passionate about making KPMG a great place to work through her focus on people and inclusion. She's a Notre Dame Talent Acquisition Partner for Audit, a member of the KNOW No Living Green and Multi-Faith BRGs, and a KPMG Culture Champion. Based out of the New York City office, Sarah's global clients have allowed her to travel all over the world, and she lived in London, England for 7 years while serving two of KPMG's largest global clients. A graduate of the University of Notre Dame, Sarah was a proud Pangborn Fox and is slightly traumatized that the former residence hall in which she lived for 4 years has recently been torn down. Long live the Pang. Sarah is also a student manager for the football team as an undergrad. So we can welcome her.
Apologies, I had to get mic'd up here. So thank you for giving me a second here. And good afternoon, or I think it's afternoon now. It might just be about afternoon. But good afternoon, and it's an honor to be here at the University of Notre Dame, my alma mater, especially speaking after such inspiring speeches from a competition called Grow the Good in Business, focusing on how fintech can improve accessibility and inclusion. Quinn's already given me a nice introduction, so I won't go through all of that, but I will just give you a little bit of information about the types of clients I've served. He's mentioned that I work on consumer markets and pharmaceutical industries companies. Primarily, some of the companies that I've worked with include large global organizations like PepsiCo, Hershey, Estee Lauder, J.Crew, Mercedes-Benz, Pfizer, and also smaller, high-growth pharmaceutical and retail companies that may be pre-revenue. The other thing that I'll just mention is I did live most of my career in New York. I also spent 7 years of my career living in London. And I just want to tell you a little story about when I moved to London in 2017. My payroll and my savings at that point were all in US dollars. But my life, my rent, my groceries, furnishing my flat was all in pounds. I had no credit in the UK. I just opened a bank account when I moved there, and they gave me a credit card with a £500 limit. That is about the same amount that I had gotten as a credit limit when I opened my first credit card with the Notre Dame Federal Credit Union back in when I was a freshman in college here at Notre Dame. Even though I'd been working for over 15 years, and I'd actually made partner 2 years before, I had no credit in the UK. I was starting from scratch there. I was what is known as a thin file customer, and that often happens with young adults, immigrants, and people who are primarily cash users, people who have no credit history or low credit history. And it's really hard for those people to be able to get any kind of traditional financing or debt, take out debt in those situations. Over the 7 years that I lived in London, the entire time I was paid in dollars. So every single pound that I had in the UK, I had to bring over from the US. I remember watching exchange rates like it was a part-time job, trying to figure out when I could get the best bang for my buck in terms of what I brought over. Also looking at fees. Some banks had higher fees than others, so I was trying to figure out how I could stretch my dollars to get the most pounds out of it. I feel like I was continually watching this and trying to send money over. There was one time when I first was there, first couple of months I was there, and I was trying to buy furniture. How much furniture can you furnish a flat with when you only have a 500-pound limit? It's really, really tough. And so actually, I remember a time when I was at a store and I wanted to buy a couch, a love seat, end tables, just basic living room furniture. And I had my 500-pound limit on my credit card, and I maybe had another 1,000 pounds in the bank, but I didn't have a whole heck of a lot of money. I don't even know if it was 1,000 pounds, but I remember when I went to pay saying, can I put 500 pounds on this card, and can I use my bank card to put another 700 pounds down? And let me tell you, that was so stressful. It was horrible, and I couldn't even fathom how to deal with this in this situation. There was another time, around that same time, when I had to borrow 3 pounds from one of my first-year associates just to buy lunch in the KPMG canteen. That's $4, and by the way, a canteen is like your cafeteria here in American English. That was a real low point for me. I was so embarrassed, and I just couldn't believe it. But it taught me a really uncomfortable lesson. Access isn't just about having money, it's about being able to use it in the moment without friction and without confusion. Over time, I learned some different apps that I could use, different tools like TransferWise and Revolut. They helped me manage my money and my exchange rates in different currencies without having heavy fees, like a lot of banks have, or constantly watching the exchange rates. These tools made my life much easier. Now, at that time, I didn't use any kind of stablecoins, but I absolutely think that certain stablecoins that are perhaps not linked to a specific currency also could have been extremely helpful for me. So now I want to take a practical look at how certain tools like Klarna, where you have buy now, pay later, and other stablecoins, like where that helps, where it can harm, what good looks like when we both build for access and trust. And I think that's a really critical piece that's been touched on a couple times by David and some of the other presenters today, but I think it is a really critical piece. So let me just start with another little survey. By a show of hands, how many of you have ever been offered a free cell phone or other device through your mobile provider? Okay, that's a lot of you, not quite everybody, but a lot. For those of you that have actually taken those offers, do you know, was that phone actually free? Not long ago, I had a conversation with a really good friend of mine actually one of my former roommates here at Notre Dame. And she was complaining about her cell phone bill. With a husband and 6 kids, she said, hey, my cell phone bill every month, I'm paying so much money for devices on top of my normal fee for the service. And she said, I thought my phones were free. Why do I pay so much every month? So as a good auditor, I had her pull out her bill and show me, and we went line by line. I looked at what she had on her bill, and I looked at what was on my own bill, and I saw that actually on my bill, I would have the monthly fee come through from my cell phone, and I also had a credit that was offsetting that. And so my monthly cost, while it showed an in and out, my monthly cost was 0. And on her bill, for some of her, 10 or 12 devices that she had for her family, some of them she did have those credits coming through, but some of them she didn't. And I said, let's look at the contract. Can you pull, there's, of course, online, you can pull up the link and see what your contract was. And lo and behold, what she had gotten wasn't a free phone, it was interest-free financing. Interest-free as long as the balance is paid off in a certain period of time. And potentially, if it's not paid off in that time, a lot of expenses that could come through later. So basically, it wasn't you get a free phone today, it's you can take home a phone today without paying for it today, but you're gonna pay over time. And as long as you make those payments in time, okay, you're not gonna have interest. But if you screw up, you're gonna get hit with a lot of fees at the end and be surprised. And that difference matters. It matters especially when you're budgeting month to month, raising a family, starting a new job, establishing credit in a new company, in a new country rather. All these things are important. And I highlight this just because this is the territory that we're in right now with modern embedded financial products. What matters isn't just what credit is available, but whether the terms are clear, the obligations are understood, and the customer is set up for successful repayment. Not fintech as a buzzword, but fintech as a practical tool, when done right, to make sure access is more real for more people. Buy now, pay later, stablecoins, and other modern credit tools can genuinely expand inclusion, especially for thin file and underserved customers. But credit inclusion without guardrails isn't inclusion. It's just moving risk around and often landing on the people who are least able to absorb it. So I mentioned a little bit about my background, and Quinn did as well, but my background isn't in financial services. My clients are largely retailers, consumer markets companies, pharmaceuticals. And what I'm here to say is fintech doesn't just impact financial companies anymore. It's increasingly embedded, invisibly, into everyday businesses, especially retailers like my clients. It shows up in checkouts, inside apps, and inside subscriptions. Many high-growth retailers use platforms like Stripe. I think one of the presentations talked about Stripe earlier, but Stripe payments and for payments and subscription management, because the customer experience demands it. People want to be able to pay instantly with their phone or automated payments, but also because the company's cash flow requires it. Using a payment processor like Stripe allows retailers to convert cash faster so that they have the cash on hand that they need to run the business, to make payroll, to buy inventory, to fund capital projects, among many other things. Finance is no longer a separate event. It is part of how customers experience a company and a brand. And because it's embedded, it can either widen access or widen confusion and increase customer harm. Here's a little before and after that often happens at checkout. If you remember the story I told you about when I was in London and trying to buy furniture, a lot of times a customer gets to checkout and maybe they realize that they can't actually pay today or they don't quite have enough money to make the payment. They might apply for credit, they might get declined, and they probably don't often know all the reasons why. After, a customer sees an installment option at checkout with clear terms, costs, and due dates. The customer can choose a plan that fits their cash flow reality without stigma, without a complicated process to get approved. And they can often even do that before they get to the point of checkout if they're thinking about it and planning in advance. When this is used as an inclusion lever, it can reduce friction, expand options, and meet people where they are. But the difference between inclusion and harm is whether the product is designed for successful repayment and not just successful approval. When buy now, pay later and other fintech solutions are genuinely inclusive, they can support access for thin file and new to credit customers that don't fit the traditional credit or debt scenarios. They can create budgeting predictability through structured installments that allow people to plan and know what their outflows are going to be. And it can also create dignity and ease for customers by reducing friction and paperwork and stress, perhaps, at the moment that you're trying to complete a purchase. But buy now, pay later can also reduce accessibility when overlending becomes invisible, when customers stack multiple buy now, pay later plans across different providers and lose track of what they're actually paying and what their total obligations are. Sometimes terms are technically disclosed but not truly understood, as was the situation with my friend and her cell phone bills, where she had just a lot more actual outflow than she thought. And sometimes servicing is weak. Disputes, returns, refunds, and hardship situations are handled poorly, creating stress and mistrust. Growing the good can't stop at origination. Inclusion must also include servicing. So my job as an audit partner includes ensuring that companies are focused on things that keep financial systems reliable: controls, governance, and accountability. Those are enablers in inclusion in fintech. Innovation in fintech for retail and other companies requires innovation with guardrails. In plain terms, this means affordability by design. Limits in underwriting should prioritize repayability, not just closing the deal at checkout. Transparency that's real in plain language terms at the moment of decision. No surprises for fees, returns, or any late payments. Accountability across partners. Retailers, providers, processors, and other parties need clear leadership and ownership and strong oversight. Responsibility cannot be outsourced. And data governance is critical for inclusion. If data is inaccurate, biased, or poorly governed, the people who are misscored, misserved, and mischarged are often the people that we're trying to include. So how do we make sure that innovation in fintech is inclusive? Here are 3 things that I suggest we keep in mind. Clarity. Can a consumer explain the total cost, the due dates, and the repayments that happen without having a law degree? Is it understandable? Fairness. Are outcomes being monitored so that thin file and underserved customers aren't included on worse terms and or set up to fail? And trust. Are controls and third-party accountability strong enough that the product works reliably, especially when customers are under stress? Let me end where we started, with the idea of growing the good. Fintech and other tools in that vein can particularly be a part of that. It can turn a moment of exclusion into a moment of access. It can help people manage cash flows in real life, not just on paper. But growing the good doesn't happen automatically. It grows when we design for successful repayment, when we're transparent, and when we govern data responsibly, and when we treat trust as the product, not just for marketing. Fintech must educate consumers and teach the basics: total cost, repayment dates, what returns and refunds mean, and how multiple plans can quickly and quietly add up. Because when consumers understand the product, and when companies expand their offerings through fintech with guardrails, inclusion becomes real and sustainable. Thank you for having me today. Congratulations to all of the participants. Your presentations were truly interesting and inspiring. And thank you all for committing your time and your talent to growing the good in business. Thank you.
All right, so we're going to go ahead and announce the final decisions of our judging panel. When I announce your team, I would invite every team member to come on up, receive their award. We'll have photos as well, and then we just ask you that you just stay up here so that we can get a big shot as well of everyone up there. Okay, so let's start with the undergraduate teams. And remember, we're going to have 2 third-place teams because we advanced an additional team this year. So tied for third, for their practical integration of stablecoin and their impact on the community, we have Credit Halo. Congratulations. Yeah, thank you. And then also tied for third for their boldness and consideration of cross-border applications, we have Mendoza's Finest. Right, in second place, for the compelling nature of their presentation and having the highest social impact, we have the Competitive Advantage. And then in first place, for their feasibility and use of stablecoin in their presentation, we have Golden Access. You can stay up here. We'll have our graduate teams come on up and join as well. All right, so on the graduate side, in third place for their impact on the Notre Dame community, we have Team Ask. In second place for their presentation on a topic that is very timely with the potential to participate in relevant and current discussions, we have Team Nest Fund. And then finally, for their use of stablecoin in their model, we have Team One. All right, we can give all the teams a big round of applause. Yeah. All right, so as we formally close, I just want to share a final word of thanks to those who made this day possible. So to our visionary sponsors and judges, your investment really fuels a better future for our students and our communities. To David and Sarah, our speakers today, thanks for sharing the example of your leadership with us. And I also want to extend a special thanks to the Mendoza faculty and staff who worked behind the scenes in planning this entire event. And then to the students, again, congratulations. I got to meet some of you for the first time through this competition, and I can personally say this is my favorite day of the year. I already told you that. And I'm very proud of all of you. Your presentations embody the mission to grow the good in business. And you have really shown through your presentations that business can really be a builder and a sustainer of hope.